Hello, Facebook family and friends. How are you today? Hope you're well. Welcome back to Facebook. Today, we are going to discuss about property investment through super. Now, before we get into this, I wanted to very quickly talk about some of the assumptions and some of the cost-benefit analysis that we are going to do here with three key scenarios. So the three scenarios are basically investment through retail super, investing using your super, buying a property for cash, and using a mixture of debt, that is the bank's money, and also your own super as a deposit to buy a property in your self-managed super fund. Now, before we get into a lot of these details about the scenario, let's understand the real assumptions here. So there are three core assumptions that we are taking here right now. The first assumption is that average super fund would charge about 1.2% of your super balance as a management fees. Now, why are we making this assumption? We are making this assumption because people don't know about this, and it's important to include this as part of this financial modeling. So what is this 1.2% of your super balance? So this is a management fees that retail super will charge you. They call it a management fees. It's a split between an administration fees, investment management fees, performance fees, an investment switching fees, or an advice. An SMSF or self-managed super fund, on the other hand, would likely cost a bit around $1,400 to set it up, but annually would cost around $2,000 and remains pretty much similar year on year. What does that mean? So that means that as your super balance grows in the retail fund, the funds keep charging you more and more, whereas SMSF or self-managed super fund fees year on year wouldn't differ so much. Why don't we usually see these fees? You don't see them usually because either they're hidden or not explicitly called out in our retail statements, or most of us, and I'm guilty as charged, don't bother to check these. Instead, just check the annual super balance or the super balance at a given point in time. Second assumption. So the second assumption is that, what is a retail super going to deliver as far as the return goes? Now, as part of this financial modeling, we're assuming that an average retail super delivers a return of about 5.8% per year. Now, this is not my assumption. This is retail super's assumptions themselves. Now, people would argue that, they've made 18% or up to 22% this year, but they've been making, 7% year on year. But there's a big but there. So there's a lot of seasonality involved in how super delivers their returns. Now, for example, let's talk about some of these examples. 2016, your super would have delivered about 3%, a return. 2020, at the start of COVID, super actually went negative for a lot of people. You were actually, delivering some losses in your super annuation. 2008 and 9, when the GFC hit, an average Australian fund lost about 22%, whereas the property market actually started rising, as soon as the GFC was hit. So an average member in 2008 and 9, August, when the GFC hit, was if they had about $100,000 in the super in 2018, they would have about $164,000 available to them in 2018. Now that's a circa 6.4% increase, which is not a massive increase because property has seen tremendous amount of growth between 2008 and 2018. Now, ultimately, when you talk about property growth, it comes back to the interest rates and lending policies, which are the key drivers of the property market in macro terms. And we'll talk about these as well as we go along the video. So, assumption number 3. The assumption number 3 that we are talking about is we are only looking at residential properties here. And the assumption that we are making here is that on average, a residential property grows or doubles every 10 to 12 years. This is practically a low-hanging fruit. And the reason I'm calling this a low-hanging fruit is because there's been instances within my own sort of portfolio where property has gone double in less than 10 years, probably about 5 to 7 years time. For example, I bought in Reservoir in Melbourne, and I keep talking about some of these examples in my live videos, where between 2015 and 2020, the price have doubled. You can see Frankston, you can see Geelong, property have grown by about 30 to 40% in less than 3 years or 4 years. Now, it's a very sort of a low-hanging fruit example or low-hanging fruit assumption where we are talking about 7.5% or double every 10 years. Now, what sort of properties are we comparing here when you're talking about residential properties? And that's the key. What sort of property doubles every 10 years? Now, it's not every property that doubles every 2 years. I'm talking about a property that is an established house that is in a growth zone where you can manufacture your own equity. You're not talking about apartments. We're not talking about off-the-plan properties. You're not talking about properties bought for your forever home, house and land packages, brand new developments. Those properties, of course, there would be countless number of examples where over a period of 10 to 12 years, even 15 years, the property growth has not happened. So it's important to understand this definition, because we would be using this definition to discuss the key risks when investing via super, especially when you don't know what you're buying and when you're buying. Okay. So those are the key sort of 3 assumptions that we are talking about here. Now we are going to go into the scenario. So let's talk about some of these scenario assumptions that we are looking at right now. So scenario 1. In scenario 1, you can see that we're going to call it a person, Dave, has $200,000 at year 0 and he's investing $200,000 in 3 different scenarios. Now, in first scenario, it's a retail super over a 10-year period. You can see from the modeling that the $200,000 balance has turned into about $311,000 at the end of year 10, which basically generates about $112,000 in appreciation. Now, even if you assume this at say 7%, okay, you would see that the appreciation is still about $150,000 over 10 years. Okay. Now, scenario 2. What are we looking at scenario 2? In scenario 2, you're talking about buying property with cash using your SMSF. So you're turning your retail super into super self-managed super fund, and you're using that cash to invest and buy a property with cash. Now, some of you may argue that, could you really buy a property with $200,000, Moss? Yes, the cheap established property or home that we've acquired for a client is about $150,000 positive cash flow, again in a growth suburb. So this scenario is definitely a valid scenario. Now, in this scenario, what we are also assuming is that there is a cost of SMSF that comes into question here. There is also rent. There's other expenses like, management fees of the properties, rental management. There is also stuff like, water, insurance, etc. that we are assuming here. So what we are seeing here in scenario 2 is that the property that was acquired for $200,000 has grown to about $440,000, which means that there is about $233,000 of appreciation built in here. You can see that the delta between scenario 1 and scenario 2 is about $121,000, which basically means that scenario 2 is about $121,000 better than scenario 1 over a 10-year period. Now, scenario 3. So let's talk about scenario 3 and what's happening with scenario 3. So scenario 3 is the most interesting scenario here. And what we are looking in scenario 3 is basically using debt or bank's money together with your cash into super to getting a property. Now in scenario 3, we are going to reach out to the bank and I'm assuming a worst case scenario here. So what I'm assuming is that the bank is going to give you a loan at 5.8%. We have been able to secure loans under 5%. I'm also assuming a rental yield of 4%. We have been able to manage getting better rental yields, 5, 6, 7%. And I'm also assuming that the loan is a principal and interest loan. So it's a P&I loan at 70% LVR. Now, again, it's better to assume a worst case scenario so you can see the true comparison. So you can see in scenario 3 that although there is this net negative gearing impact, net negative impact during the overall 10-year cycle, you're still making about $545,000. So this is the net negative that I'm talking about on an annual basis, but there is still a benefit of about $544,000. What that basically means that there is growth coming in these properties and you're using banks' debt to offset some of that growth or build up or catch some of that growth and ultimately, making a better scenario in scenario 3. Now, this negative, you can see that it's dropping off as the year passes through in the first year, in the first 10 years, which basically means that over the next 10 years, this would be a positive impact and you would not have to take this net negative reduction in the scenario 3. This would be a net positive reduction coming into it. which basically comes to the point that your scenario 3 is about 400,000 better than scenario 1 and about 300,000 better than scenario 2. Now, what is to say that let's assume that scenario 2 and 3 does not deliver a growth of about 7.5%. So property does not grow or double every 10 years. Let's assume that the property doubles every 16 years, and let's reduce this number from say 7.5% to say 6%, and let's see what these numbers basically do. So when you are changing these numbers to 6%, you are still seeing that the total net benefit is still about 364,000, which basically means that this scenario is still about 250,000 better than scenario 1 and 186,000 better than scenario 2. Now, also one thing that we haven't considered in these scenarios is holding multiple properties in SMSF, which is 100% possible. Now, that is where the real charm is. How do you use all the super money in acquiring multiple assets? And that's the story that I want to really share and really dwell upon as to how do you make sure that you are acquiring these properties that are in the growth suburbs, that are positive cash flow, and they have manufactured equity component in there. Now I'm going to take a pause here and stop sharing this screen so that we can talk a bit about the risks of buying property in SMSF. And what are the risks? So some of the key risks to consider when buying property in SMSF. The first and the foremost risk that people forget is buying a wrong property in SMSF or self-managed super would be a killer. So if you buy a property that is a non-growth property, which is not delivering the right yield, you basically killed your retirement dream. Having said that, if you pick the right investment stock, and if you're able to secure a good property, which is pretty, low-hanging fruit, it's pretty easy to do, then you would be set up for life. So it is very, very important to get the right property advisor in place and not some sales agents or some property guru or some data nerd talking about, how to buy these properties or selling you brand new development stock or off the plan properties or, apartments or townhouses. You need to stay away from some of those sort of investments, or I shouldn't even be calling these investments when you're acquiring property through SMSF to de-risk this particular risk. Now, the second risk, which is quite key also, is that there is a significant limitation built into the laws that enables SMSF to only borrow a single acquirable asset. Now, what does that mean? Now, single acquirable asset basically means that in simple terms, any equity buildup cannot be used to purchase a subsequent property or another property, similar to what you would do in your personal profiles. That is why it's important to not overcapitalize purchasing, properties in your SMSF profiles with super money, or using or keeping that excess money on the side so that you can do a secondary purchase in when you're setting up your SMSF. The third important thing to note, or a risk to this, is complexities of investing via SMSF property. Now, if you get it wrong, there are hefty fines, so you ensure that you are again not lured by property investment gurus or sales agents or knob buyers agents who are suggesting you to buy an SMSF, and you're making a massive mistake by doing that, because of course it's your retirement fund at the end of the day. The fourth important risk to consider is understanding the implications of stamp duty, land tax, capital gains tax, which is quite key. You can set up multiple SMSF to hold multiple properties to reduce some of these impacts. And again, that's a strategy that an SMSF advisor or financial advisor would be able to, talk to you in more detail. The fifth most important risk to consider here is the concentration risk. So what is the concentration risk? Well, if you're looking at retail fund, there is a less of a concentration risk there because they're managing the risk through diversification. So they're using various asset classes to provide you with a buffer. In SMSF, predominantly because you're buying one property, you're concentrating all your risk in one place. So it's always important to get the right advice and get the right people on board when you're talking about SMSF investing. Sixth, and the last, which is the most important again, which people tend to always forget about, is when you're doing SMSF investing or buying property through SMSF or setting up an SMSF, and you are basically divorcing out of retail funds, you need to organize your own personal insurances around, death insurances or life insurances, or total permanent disability, or TPD, what they usually call it. So it's always good to seek financial advisor and SMSF advisor to sort some of these things out, so that you're not missing out on some of the key things in your life as well. What can you borrow in super? That's an ultimate question that people ask me most. What can you borrow in super? Now, depending on the lender, you can typically borrow up to 80% in residential property, or about 65 to 70% for commercial properties. Now, we're going to do a separate session to understand what truly the borrowing means in super and how do we go about doing that. But it's important to note here that the loan to value ratio, or LVR, that people suggest is subject to postcode restrictions. Again, speak to the broker, understand, what are the restrictions around postcode and how does that impact the interest rates with the LVRs that the lender is going to offer you. What can you not do in super? And that's a $1 million question, because people need to understand that. So you can't do any active developments in super. You can't do subdivisions in super. You cannot buy house and land packages. You cannot buy off the plan properties in super. You cannot buy a block of land and build on it in super as well. What you can definitely do is a commercial property development, and that's a different conversation to have. And you can still do residential developments in a specific way, which basically means that you can set up a private unit trust, and SMSF, which is your SMSF, can invest via purchase of units in that private unit trust and undertake a development through that unit trust. The important thing to note here is that the SMSF and the related parties within the trust cannot own more than 50% of the total units. And these type of units, these type of trusts, when you set them up, they are called SUIT, or Superannuation Unrelated Investment Trust. Again, come to us and talk to me, or talk to an SMSF advisor or a financial advisor to understand how can we successfully do that. Another $1 million question that people tend to ask again and again, or should I say two questions, is what sort of money do I require to buy a property in SMSF, and who is the best person to speak to when I'm doing investing in property via SMSF? So when you base this on ASIC requirements, ASIC basically recently advised that you should have a minimum base of about $500,000 to invest in SMSF. Now, I've shared Dave's story, or my story, to invest via super, but reach out to a financial advisor or an SMSF advisor and a tax accountant to understand what is the best outcome for your own personal scenarios. Who's the best person to speak to? Now, there are 5 key people that need to come in together when you are talking about SMSF advising. What should I say? 5 key people. So there should be a financial advisor, a tax accountant, an SMSF advisor, a property advisor, and a broker. So all these 5 people need to be working together, that they're not only that they are advising you for right financial strategy, but also the right property strategy when you're investing in SMSF. When I'm working with my clients who are requesting to submit, who are requesting to buy a property via SMSF, we aim to understand what is their property strategy, what can they possibly buy there, what's their age looking like. We tend to again stay away from off the plan properties, brand new house and land, apartments, townhouses, properties in non-growth suburbs, properties in super regional areas. We tend to stay away from a lot of these things, but I also tend to stay away from duplexes and dual keys, because there is hardly any growth that comes in, or they offer some mediocre yields in some of these areas. And that's why it's very, very important when you're talking about SMSF investing in property, that you are taking 3 key things into account. So that property needs to have a generous yield to it. It needs to be in a growth suburb, and needs to have a positive portion to it where you can manufacture your own equity. So again, I need to re-emphasize that don't go around following sales agents or other buyers agents who don't know anything about SMSF, or property gurus, or some data nerds talking about SMSF investing. It's always important to have this right team in place who can guide you and assist you in acquiring the right property in SMSF. Now, we have seen these 3 scenarios, and clearly scenario 3 really sticks out and is the best scenario possible. But there should definitely be a scenario 4 where you can acquire multiple properties in SMSF and really grow your portfolio. That is it from me today. Thank you very much for listening to me. This is again Moss from Investor Partner Group. Thank you. Enjoy your day, and I'll talk to you later. Take care.